Well, hi there, everyone. Happy Monday, September 22nd, and welcome to Chart This with Dave Keller. I'm your host, Dave Keller, coming to you from the first day of fall here in Redmond, Washington. Little cooler here these days. We actually had some serious classic misty Seattle rain yesterday on Sunday morning, but it kind of tapered off. And today, just kind of a nice classic early fall day, but I'll take it. Hope you guys are all doing well wherever you're tuning in from. Thanks so much to those of you that are tuning in live as we live stream on Facebook, LinkedIn, YouTube, and X. Pleasure to have you guys join me as we go through the charts together. Please ask questions anytime during the live stream. At the end, I'll take a question or two before we wrap for the afternoon. If you're watching the show later on our YouTube channel, thanks so much for tuning in when you can. And just use the comment section below the YouTube video to ask any questions. We had an all mailbag episode on Friday, and if you missed that one, kind of a fun one where we had a couple stocks we talked about. We talked about TTD, we talked about Reddit, some questions on Bollinger Bands, on exponential moving averages, the 30-week moving average, which was a one that hasn't come up too often. So check that one out. That was Friday episode of this show. All right, with that in mind, let us get to the chart, shall we? And as we look at the markets today, kind of more uptrend, basically onward and ever upward. That's a phrase that I usually reserve for raging, persistent bull markets. I'm dusting it off and sharing with you again today as we almost breached 6,700 for the first time. I mean, if you had S&P over 7,000, I mean, not many did at the beginning of the year. And I'm not saying we're definitely going to get there, but it wouldn't take much beyond what we've seen so far. I mean, that's 300 points away. That's some big days between now and that moment is all it would take. The question is, is that a straight line just from here? Do we just keep churning higher? And it certainly seems that at some point we have to have a meaningful pullback, and you're seeing that in some areas of the market, right? We'll talk about home builders, which have come off here recently as rates have popped a little bit higher. What was the one I was just looking at? Motorola, MSI pulling back in September. So there are charts out there that are having kind of those meaningful pullbacks, some financials as well. But boy, the leading growth names just continue to move higher. It's going to be kind of a growthy chart session here because I've grabbed a number of different growth stocks, some that I think are just important to recognize the strength, others that I think are at more actionable levels that we'll go through together. With that in mind, though, the S&P up 0.4%, closing just below 6694. Look at the weaker open on the Dow, right? So the S&P basically opened a little bit weaker and then reverted higher. The Dow opened way below Friday's close, but made up all of those gains in the first 90 minutes of trading. The NASDAQ composite opened slightly lower, but accelerated to the upside. So we're back to that kind of familiar growth configuration of the NASDAQ over the S&P over the Dow. Mid caps and small caps more neutral. You can see mid caps almost made it to a net positive for the day, but not quite, just slightly lower from Friday's close. The S&P 600 small cap index ended up about 0.25% above Friday's close, but that's after a late hour rally. Volatility still remains pretty low. We finished just above 16, but that's still fairly low volatility. So that mid-teens range is where we've been for quite some time. That basically tells you that the options market isn't suggesting any major risks at the moment, at least not that is being priced into that market at the moment. When I ask smart people whose work I've followed for decades, what do you look for in this environment when everything's kind of just low volatility uptrend, everything's kind of honky-dory, up and to the right? Most of them say something about volatility, right? Look for a spike in the VIX. That's the red flag. Until then, things just aren't getting that uncertain. And that's where we're at, still in the mid-teens on the VIX. Looking at the bond market, it's not a ton of movement here today. You can see that the yield curve generally drifted higher, although the short term remaining fairly low. We had the Fed lowering rates last week, market pricing in further rate cuts at the end of October. Again, in December, those will be the last two Fed meetings of 2025. A lot can happen between now and then. Just this week, we've got the latest PCE data that comes out, I think, on Friday before the open. PCE is another inflation gauge, sort of the Fed's preferred inflation gauge, more than CPI or PPI. So we'll keep an eye on that. I mean, any big change in inflation data maybe changes the trajectory of the of Fed rate cuts. But for now, the market basically pricing in another 25 basis point cut at each of those next two meetings after last week's 25 basis point cut as well. So the 10-year yield finishing around 4.14, long bond around 4.75, 5-year point around 3.7%, dollar slightly lower, not too much, and bond prices, the TLT down about 1/3%. The commodity space, I mean, lots of green here. I recorded a video earlier today, my weekly show on Stock Charts TV. We talked about silver. Basically, I revisited the special episode that Grayson Rose and I did a couple weeks ago. First week in September, right after Labor Day, we did our top 10 charts to watch for September. I threw 5 charts. Grayson threw 5. Actually, he threw 6 charts in this time. And one of mine was silver, and it wasn't the silver ETF. What was it? I actually don't remember. I think it was the silver SIL. Does that make sense? Yeah, it was the silver miners, the Globex silver miners SIL. It's up about 25% in the last month. I mean, it's amazing how the space has just continued to thrive. So check that out on Stock Charts TV. Good sort of revisiting. It's so funny. I mean, in the business of talking charts, I'm often throwing examples, and then I'm kind of moving on to the next show or the next episode or something that I'm doing. And not often enough do we go back to a decision we made a couple weeks ago, a couple months ago, a couple quarters ago, and just check, how did that go? What went well? What went poorly? And it's something I do in my own portfolio, and I would encourage you to do the same. Hopefully that exercise encourages you to go through that thoughtful learning process. Today, silver and gold both up, the GLD up 1.7% to 345. Silver, the SLV ETF closing above $40 a share, up 2.6%. Rest of the commodity space kind of mixed, particularly the energy side. Natural gas prices were lower. Energy stocks did not have a particularly great day, as the chart of crude oil still does not look very encouraging. I'll tell you what else does not look very encouraging so far coming out of the weekend. Cryptocurrencies. You can see Bitcoin trading below 113,000. That's down just over 2%. From yesterday's close, which is Sunday over the weekend. Ether prices down almost 6%. All of the top 10 coins down in the red. So the crypto space struggling here, kind of limping through the summer, now into the early fall. Day one of this of the fall 2025 season. Not a great start for cryptocurrencies. Looking at the 11 S&P sectors, kind of an interesting day when you look at the sector returns. Technology, which has been, a leadership space, certainly off the April low, but August significantly underperformed. September so far significantly outperforming, back at the top of the leaderboard, up 1.5%. Utilities number 2. Utilities now trading more like a growth sector because in no small part, all the energy requirements of generative AI and other energy hog types of things. So the utility sector up 1%. Industrials, REITs both up about 1/3%. Everything else flat to down today. On the downside, consumer staples down 1.1%. Communication services down 1/3%, as are consumer discretionary. Our market trend model, we addressed this with our market misbehavior premium members. No change to that model. It's been basically bullish on all time frames since the end of April, coming off that April low, kind of one by one. And the long-term model actually had never turned negative. So the short-term and medium-term models both turned bullish by the beginning of May. And except for 1 week where the short-term model flipped, I think in July, the whole rest of the time it's been bullish on all time frames. And, again, when I think about looking back at the end of the year, for me, just the strength of the trend and just trusting that a trend will continue until you get evidence that that's not happening. 2025 is going to be a perfect case study in that sort of approach. By the way, Trend Following 101, my latest webcast is coming up this Wednesday. I'll tell you about that in a moment. If you haven't signed up, still spots available if you'd like to join us. Let's see. Breadth data, still not great. And I think, in this environment, when the charts generally look good, when the S&P generally looks great, when the NASDAQ looks fantastic and technology and other growth sectors are thriving, you look for any signs that diverge from that very bullish trend and that bullish thesis. And for me, the less than impressive breadth data is probably top of mind in terms of things that just don't look great, right? If conditions are that strong, the advanced decline data should look stronger than it has. Today, we have the S&P making new all-time highs, just continuing the upward trend that we've experienced consistently since the April low. But on a day like today, where the S&P is making new high, it's kind of a coin flip, particularly on the New York Stock Exchange, 49% to 48%. The S&P decliners outweighing advancers, same on the mid-cap space. The NASDAQ is where you're seeing strength, right? And this is where you can see the breadth data a lot less neutral, a little more positive. But sort of looking at the broader markets, particularly when we look at outside of the growth space, less impressive, right? And certainly not validated. It's not like a feel-good rally. A feel-good bullish phase should be breadth data, quite constructive, momentum supporting the upward trend, volume supporting the upward trend. And we're seeing some of that, but we're not seeing all of that. And I would say the lack of breadth support, that's just going to be an issue, I think, at this point. Let's see. Looking at the growth space, kind of a mixed day today, right? So on the top side, you have Apple up 4.3%. You have NVIDIA up 4% today. Tesla having a decent day as well. But then on the downside, you have Amazon, Meta, Broadcom, all down over 1.6%. Alphabet and Microsoft had a down day. As well. So even within the Mag 7, kind of significant mega cap names, we've got some dispersion, I guess is the word I would use. A spread between the return profiles today. Not great, but good if you're Apple or NVIDIA. And NVIDIA represents, just broad strength in a lot of semiconductors. Broadcom down today, but a lot of semiconductors just having a pretty decent day today, and a decent month, as it were. All right, I think that's it for the front page here. We're going to get to a heat map. I do see some questions coming in and some comments on each of those platforms. Thanks again, those of you tuning in live. Please drop questions as they pop in your head. I welcome them as always. We'll take a question or two at the end of the episode. Anything we don't get to, we'll put in the mailbag. We're planning a mailbag episode again this Friday, and we'd love to answer one of your questions for all of our benefits. All right, let's look at the market carpet, or if I still lived in Boston, we would say the market capit. And shall we look at these 500 stocks, the S&P 500, in a heat map format? So looking at today's returns, you'll see why it did not feel like a great day, right? If you literally take your hand and cover the upper left quadrant, which is technology, which is the biggest weight in the S&P, and obviously a lot of significant names in there. If you cover that up, the rest of the heat map does not look particularly good. Random pockets of good movements across this heat map, but not like a general thematic, oh, wow, look at financials, look at industrials, look at, energy. Like most sectors are kind of mixed and kind of net neutral is what I would say. So technology is really the juice today. And we can see two of the three biggest names and three of the five largest, NVIDIA, Apple, and Oracle, all having strong updates today. Great way to start the week. You can see underneath those top names, some of the semiconductor names like Applied Materials, LRCX, that's Lam Research, KLAC, all pushing higher. I didn't grab the chart of KLAC, but getting above a big round number. We powered above 1,000. This was on Wednesday into Thursday of last week. We gapped above $1,000 a share for the first time. Talk about a big round number. And then Friday and now today, just remaining above that gap. So, again, big round numbers. When you have charts just in strong uptrends, it's, looking for potential resistance points, looking for areas where you're like, all right, maybe that's where this thing stalls out. But I'm not seeing it. I'm seeing the RSI right at 80 right now. So we're crazy overbought, which overall usually means we're in decent shape and at least make a new high at some point. So a lot of strength in semiconductors, and that was definitely not the case in August. One of the biggest shifts I've seen from August to September is the resurgence in technology, the resurgence in semiconductors. And it's not just semiconductors. You can see like WDC just lights out uptrend off of the April low. We just bought a Dell. I bought a Dell computer. That's fun. And had to upgrade the gaming PC, where I run basically awesome video games like Elite Dangerous and then Optima. It's basically awesome games and awesome charting software is basically the dual purpose that I have for that PC. But the other one was 5 years old. The new one, it's an Alienware. It works pretty well. I'll take it. So, technology is the strength. I would say elsewhere, right? If you're looking as more of an allocator, I mean, not great. And I'm noting particular communication services has been one of the better sectors in September, kind of hanging in there with technology and consumer discretionary. But over the last week, we're now starting to see a bit of a softening there. So Alphabet down today, Meta down today. These are still great charts. These are charts still, near very close to their previous all-time highs. But pulling back a little bit, something to watch for. Excuse me. In terms of weakness, what stands out as being red? I would highlight a couple things. Number one, in the consumer discretionary sector, gambling and housing. Housing and gambling, those are the two that are struggling here. You can see Win, MGM, that's part of like the gambling cohort. Charts like MGM, kind of less ideal as the month of September has gone on. At the end of August, making a new swing high. Now late September, kind of retesting the August swing low. I did grab the chart of Lennar, but you'll see like Lennar, DR Horton, Pulte, NVR, these are all home builders, had been having nice runs in the last quarter, but just in the last week or two starting to rotate lower. Spike in rates is certainly not helping that thesis. I think the 10-year yield coming down was a big sort of tailwind to that group of stocks. And you can see that on like the ITB or the XHB, which are two home builder ETFs, or the individual names starting to reflect that as well. All right, let's continue on and look at some charts. Before we get to all the charts, two quick reminders for you, maybe three. Number one, I'm doing a free webcast this Wednesday. I haven't done one since the summer. I think the last one I did was back in May or June. Took the summer off from doing some webcasts, but thought it'd be a lot of fun to get these back started here for the fall. We're going to do a free webcast on Wednesday, the 24th, 1 p.m. Eastern, 10 a.m. Pacific, called Trend Following 101. Learn the rules, follow the moves. If you want to learn more about some of the charting techniques that we talk about, look through some more examples, and leaving the session with a good set of practices to apply to the next stock or ETF that comes across your desk, please join me. You can sign up at marketmisbehavior.com/trend. Please join me for that free webcast. Should be fun. Always an interesting way to take a step away from the day-to-day movements in the markets. Focus on some education. Also, I'll be speaking at the Orlando Money Show. That's coming up about a month out, October 16th through 18th. I will be there on the 16th and 17th. That's a Thursday and Friday. You can sign up at marketmisbehavior.com/money show. I'll be doing a presentation called The 4 Pillars of Investing Success. In the age of AI, in the age of awesome technology, old school in-person events are just so special. And it would be a pleasure to shake your hand, say hello, and meet some people who watch the show. So please, if you're in the Orlando area or can get there, sign up for that event and make sure you come say hello. marketmisbehavior.com/money show. Last thing I'll tell you is I actually joined the Seattle Symphony Chorale. I'm a musician, in case you haven't picked up on that at some point, as I drop some music reference, and have not sung in a choir for a number of years, but I love singing and have some pretty good experience in that area. So if you're in the Seattle area, check out. We're singing the Vaughan Williams Sea Symphony coming up next month in October. Should be a really, really good concert. Handel's Messiah around the holidays and others. So check that out if you're in the area. All right, let's continue on here, looking at a daily chart of the S&P 500. Moving averages in the proper order. This is a chart in a primary uptrend. The chart making higher highs and higher lows. The 21-day EMA sloping higher. The 50-day simple moving average. The 200-day simple moving average. All trending in the right direction. All in the proper order. This is a market in a primary uptrend. Innocent until proven guilty. What would prove this guilty? For me, it usually comes down to two things. The 21-day exponential moving average. I've found that is such a helpful peace of mind kind of technical indicator, right? In this sort of environment, as long as we hold above the 21-day EMA, it's just noise, right? It's just part of the uptrend phase. Anything below the 21-day EMA, then I need to reevaluate things a little bit further. Also recent swing lows. Most recently, you'll see Wednesday's low of last week, right around 65.50. The 21-day EMA right around there as well. So that would be an initial level. Anything above that is nothing but pretty good, I would say, at this point. RSI is overbought. We're overbought now for, just the fourth time in 2025, maybe fifth time if you consider this a separate one, right? So we were not overbought coming out of the December, coming out of last year. January, February, March, we're more in a downtrend phase coming out of that February high. Then we're overbought in May, end of June, July, and then again here. And you can see in those previous times, right? When you're overbought in a primary uptrend, that often means we're at the upper end of that channel, right? We're sort of in the upper end. That doesn't mean that the primary uptrend is over. It just maybe means we pull back a bit and make that next higher low. And that's what you'd be looking for in this particular kind of environment. A pullback to an ascending 21-day EMA, at worst, like a 50-day moving average. Those are where you sort of good downside targets on a pullback. The fact that we're overbought tells me I may not want to be buying into this at the particular moment. Wait for a pullback often presents a decent higher low to look into. That's sort of what we're thinking this week. One of the charts just to think about thematically, this is a relative performance chart, looking at the relative performance of the equal weighted S&P 500 and the regular cap weighted S&P 500. So as a reminder, the S&P 500 index and the SPY, the S&P Spider, is market cap weighted, meaning the biggest names have a huge weight. And I haven't done this in a while, but it's like the top 10 stocks in the S&P are about the same weight as the bottom 400, 450, something like that. It's crazy how big the largest names are relative to the weight of all the other names in there. So it's an exaggerated top heavy index. The equal weighted S&P literally treats all 500-ish stocks equal weighting, right? So number 500 is the same weight as number 2. And so that gives you a better sense of the broad universe. And by looking at the relative performance, we can see, is it the largest kind of mega cap names that are outperforming, or is it the other stuff? Here you can see it's not the other stuff. And that's been a theme for a while now, with some exceptions, right? Like summer of 2024, we had a couple months where the equal weighted S&P outperformed. Here, coming out of the February market peak going into the April low, the equal weighted S&P started to rally as some of those mega cap growth names really started to struggle. But from the April market low to where we're at now on September 22nd, 2025, it's been fairly consistent that the equal weighted S&P has underperformed. And what that means is still a mega cap driven market, with mega cap working so well, with charts like NVIDIA and others, at or near new all-time highs, and with growth outperforming value. That ratio is going to continue. This is one of those charts to look for that inflection point. And when this starts to rotate higher, that's a warning sign that things may be starting to change. We saw that in mid-August as technology took a breather and some other sectors started to improve a little bit. We can see now from mid-August to mid-September, we've kind of gone right back to that previous trend. Keep an eye on this chart for now, still favoring the mega caps over everything else. NVIDIA having a nice start to the week, up about 4%, not quite to a new high. We need to get above $185 a share. That's why I have an alert. I would encourage you to keep an eye on that. NVIDIA has had a pullback, right? Since the end of July to Labor Day, not a great look, and got below the 21-day and also below the 50-day moving average at the beginning of September. From there, though, it's been chopping around, and then today appearing to resolve to the upside. So I think a break above 185 would validate a new uptrend phase for this mega cap semiconductor name. We're going to get to some other semiconductors, I think at least one or two here in a minute. In the meantime, Apple also looking quite strong here. This is coming after the product release here earlier this month with the new iPhone line, new pretty much everything, new iOS, some significant stuff. And initially, the stock sold off after that announcement. But you can see since then found its footing and now making a new high, very close to making a new all-time high, getting above that December 2024 peak, which is just below 260. So we're very, very close to breaching that today. Teradyne is another semiconductor name, and I started grabbing a couple of these. I'm like, all right, I can't grab the entire semiconductor space to just show all of these different charts that look pretty good. But trust me, these are just a couple of some of these, and you can look at semiconductor ETFs, of course, to get a sense of this space overall as a theme. And while there are some outliers that don't look as good as others, Teradyne looks pretty solid here. Again, one of the screens I run all the time, or one of the scans I run, are stocks making new 3-month highs. And I do that to try to surface charts like Teradyne. I like knowing things that are in primary uptrends. I like knowing things that are just sort of back here, just starting to make a higher high than the last 3 months. It often shows you things that are just emerging off of a major low and sort of validating that uptrend. And I haven't been disappointed, following some of those charts that had those 3-month highs back there over the summer. Teradyne is one of those that's continued to make new highs. But note how all of these are overbought right now, as the S&P is, as the NASDAQ is. That just tells me from a tactical perspective, be ready for some sort of tactical pullback. Often could provide a good entry point, but basically says the market's pretty hot at this particular moment. Oracle is another one of those. Gap higher, a brief pullback, but holding support around 290. So this is one of those where I think the chart provides a very straightforward way of thinking about downside risk. If I'm taking a position in Oracle today, which I personally am not, but if I did, 290 would be that obvious sort of initial stop, right? That's the swing low that we established earlier in September. We've now tested that a couple times. That's where buyers are coming in. So setting a stop right there or slightly below there kind of makes sure that you remain in the trade as long as that doesn't break. But if that does break, that tells you, all right, this gap thing that we talked about, this gap higher, this new accumulation is starting to fail, and there's not enough upside momentum. So I think that's where certain charts kind of have a very, what I call a natural stop, right? That kind of jumps off the chart at you. You can see, all right, that's a level of support I probably could count on. 290 is the one I would be looking at with Oracle. The other way to think about it is set an alert for a break below that level, which would tell you, and charts like this, if you do own them, I'm a big fan of just setting alerts for all of those. What would the chart do that would tell you something might be different, and set those as alerts so that you don't have to be staring at the chart all the time. One more semiconductor. I lied. I grabbed another one. Because not all these look identical, and some of these are a little more interesting. I think Skyworks is a really compelling chart. You think about how extended some charts are, right? Some of the semiconductor names that have just been blowing out to the upside, and it feels like, I feel like I might have missed it. I don't think you can say that about Skyworks, right? Friday, we just pushed above 78. Today, we're pushing above 82. Finally getting above this resistance level. It's kind of 77, 78. And just in the last couple sessions, we've powered above here. So I like that breakout to a new resistance level. That's after breaking above the 200-day and bouncing off of support there. Nice setup there. I like that one. Homebuilders, I mentioned, right, with some of these technology names that are looking so good. What's not looking good? Homebuilders, right? And part of this is the fact that rates are starting to spike higher a little bit. There's this great kind of tailwind to homebuilders as rates were coming down, because that means your mortgages are going to be a little, less expensive, right? Better rate, home buyers, more of a buyer's opportunity for those that would be struggling to meet the payments. As rates are popping up now in September, post-Fed meeting, it's starting to put pressure on charts like Lennar. Lennar jumped out to me because if you look at this downtrend from the September 24 peak to the April 25 low, 38.2% of the way back up is around 133. We paused there before making it up almost exactly to the 50% level. And now we've gone and failed back below the Fibonacci support, back below the 50-day, testing the 200-day moving average today. So unless we can hold the 200-day, I think this chart looks really, really rough. And it already looks pretty underwhelming because of the break back below, these previous swing lows. The RSI pushing below 40 today, which is not good either, right? In bull phases, the RSI tends to remain above 40. In bearish phases is when the stock usually becomes oversold. So the fact that we're just down in that range makes me feel a little uncomfortable. So homebuilders have been a really good trade-off of there. I'm concerned about how heavy those names have looked here in the last week or so. Final chart, two more. There we go. I wanted to grab Disney. I'm sure you've heard it's hard to avoid the news about the Jimmy Kimmel show going away. Just before, as I'm prepping for the show, I saw the headline that that's coming back as of tomorrow. I certainly do not want to get into any of the politics behind any of that, But reflecting on the investment impact, there's certainly been a sort of a groundswell, a grassroots effort to, cancel Disney Plus and communicate your displeasure of whatever by taking action like that. So I thought it'd be helpful to look at the chart and just see what sort of movement we've seen just in the last week or so. Disney rolling over, and again, it's obviously not just about that, but Disney has been, in the news quite often now, and in commentary related to all of those events. For now, I would say testing key support. I actually do own some Disney. We break below that support level. The 200 days not too far below there, around 110. We break below 110, I'd probably be lightening up my Disney position, at least in some way. I'm not thrilled by that last gasp higher that stalled out at the 50-day, and the RSI never even touched 60. So you have this trend line resistance here. So the way that I think of a chart like this, we break above that trend line. That's really good, right? And ideally, we get above 120, clear these highs. That's kind of an all clear bullish breakout. We break below this support, which is the swing low from August. We follow through below the 200-day. That's a clear breakdown, get out of the way type of pattern. And in the middle, we're sort of in this descending triangle open question pattern. We're kind of in that neutral phase. So I think you have a pretty good framework to think about. For me, I'd probably be looking at the 200-day moving average. And as long as we hold that, I probably won't make any significant changes, but a break there, and I'd start getting out of the way in a stock that's done quite well. End phase at times, I should say, for Disney. It's not all been happy Mickey Mouse action on the chart. It's been struggling at times. Final chart, end phase energy. And someone asked me about this, one of my premium members. I just want to share with you guys. This is a great example of why following moving averages can be so helpful. This might be one of the examples we look at in the webcast on Wednesday because it's such a great example of a downtrend. And when you have a chart in a consistent downtrend, right? Think about or just look at what this chart has done in 2025. We've spent almost the entire time up until the end of August below the 50-day moving average. Look at all of these tests of the 50-day that just failed. Look at how the RSI barely got above 50 that entire time. And then just in the last 6 weeks, we've started to make a bit of a higher low in a way we haven't seen too much. We're starting to make a bit of a higher high in a way we've definitely not seen. The RSI pushing above 60 today for the first time since, last summer. So this is, potentially a change of character as we have a chart that's been in a clear distribution phase, now in a transition to more of an accumulation phase. And so thinking what you would need to see on this chart, what signs of accumulation would be enough for you to take a position is the question you need to answer in your process. I'll share with you some of the things I'll be using in that webcast coming up. Again, you can sign up for Wednesday's webcast at marketmisbehavior.com/trend. Would love for you to join me. All right. Shall we take a question or two? Faven86, I'll take a shot at pronouncing that. I wonder about Texas Instruments, TXN. Let's bring up that chart. Thanks for watching on YouTube, by the way. It went from 221. It went to 221 and then dropped to 179. Thanks so much for watching. Let's take a look at Texas Instruments. Yeah, thanks for highlighting this. All right, so this is one of those examples of where if you just look at the SMH or like the SOXX, the SOX index, it's an index or an ETF that tracks the semiconductor space, but all semiconductors are not created equal, right? Another example would be like Intel, which looks very different than the rest of the semiconductor space. And look at how underwhelming it was for the first half of the year. A gap higher, a gap and fail pattern here. So for every KLAC kind of breaking out, you've got Intel or Texas Instruments looking totally different. So thanks for highlighting this one. This is one of those where it depends on what question you're trying to answer, I guess is how I would say it. If I'm a swing trader, I'm probably kind of interested seeing this at the lower end of a channel, lower highs, lower lows, kind of bouncing off of the lower end. If you look at what we did here with the RSI oversold, we ended up having a pretty decent bounce after this little divergence here. So maybe I'm looking for like a tactical bounce. But as a sort of medium-term trend, not a great chart because we're making a clear pattern of lower highs, which we made here around 209, and now lower lows as we undercut the July low. So it's like, a trade, maybe I could see the argument, but as a meaningful position for me, not yet. What you would need to see, I think, is breaking back above the 200-day at least, making a higher low, RSI pushing higher. Those are all things that would suggest signs of accumulation, and I'm just not seeing any of that yet. Another thing that you can do, on a chart like this that I've often thought about, if you're looking for like a kind of short-term rotation, use like the MACD indicator, right? This is an indicator that's meant to just help you identify kind of tradable turns, right? Sort of those little legs higher or lower. So the question is whether you're trying to understand this trend, which for me is still negative and I would be avoiding it. But as a trade, maybe I'm using the daily MACD or PPO as to play a short-term mean reversion. I could get both of those approaches. But for me, definitely compared to the rest of the semiconductor space, it's not a good chart, right? And that's sort of the problem. All right, last question. Dobik, boy, I should not try to pronounce YouTube handles, but thank you so much for watching. D-Man on YouTube. When referencing RSI for divergences, do we only look at the most recent previous peak or trough, or can we reference a further back point in time? In other words, when is an RSI value no longer relevant? That's actually a really interesting, a really thoughtful question. I appreciate you asking that. So the answer is, it matters until it doesn't. And I know that's not a great answer. This is where there's a bit of an art to what we do as technical analysts. Sometimes divergences are very clear. Sometimes they're not. And I would say part of what, I guess, the value, having worked with some technical analysts who have been doing this for, years and years, we would talk about like, what's the benefit of looking at charts for so long? And the benefit is you've seen patterns so many times, right? You've seen something, and in your head, you immediately say, wow, this pattern right here, where we're making higher highs on weaker momentum as we retest a previous major peak, that is a pattern I've seen a lot of times before a stock pulls back, because it's like a big double topping pattern. This divergence speaks to the exhaustion point as we go into that previous peak. So it's not just about analyzing Home Depot. It's the hundreds and hundreds of other charts that look a lot like this that you've traded and it's worked. And there's no guarantee it's going to work in anything, right? In the financial markets, but it's a high probability play that starts to resonate for you. So, for me on a daily chart, looking back 4 to 6 weeks is kind of the amount of time I would be looking at price versus momentum to see if there's a divergence. But if you're more of a swing trader, you might be looking at like an hourly chart or a 5-minute chart and looking for divergences on those other time frames, right? That's a different set of charts and different question that you're trying to answer there. So where I have found people get into trouble is where there's a big mismatch between the period that they're trying to trade on or invest in and the chart of the time frame they're looking at on the chart. So for me, looking out a month or two or 3 or more, looking at like the last 6 to 8 weeks for price versus RSI, this is kind of the average time frame I see divergences that tend to work for me. For you, it depends on what your investment horizon is, and I would encourage you to experiment with different chart times, different periods, different time frames that help you identify the turns and the movements that you're trying to capture. Divergences could be unique to that particular time frame. For me, this makes the most sense. Folks, that'll do it. Thanks for those questions, and thanks for a great conversation. As always, I appreciate those of you tuning in live and those of you watching the replay on our YouTube channel. For now, to all of you, I'll say thanks so much for watching. Have a great evening. And remember, it's always a good time to own good charts. Have a good night, folks.